there's nothing left to do but to identify the optimum moments to buy or to sell. A mere trifle. This trifle has tantalized traders over the centuries, and a whole science has developed called technical analysis. The Western School of Technical Analysis has its roots in 19th century America. I describe technical analysis as a science. What do I mean by this? Well, one thing I mean is that it's governed by clear and rigid laws. New change in price is charted by a standard move across the chart. The chart takes no account of time, so the more times that price changes in, say, a minute, the more moves are made across the chart. One of the most universal and widespread technical indicators is known as moving averages. They are used in most trading systems that incorporate trend-following indicators because they're extremely easy to plot. Of course, although we don't have to plot anything ourselves, we've got a computer for the humdrum work. It's a good idea to understand how they are calculated, because we will then be able to use them more effectively. So, the simple moving average, or SMA for short. Let's cast our minds back to our school days and those long arithmetic lessons. No doubt you remember how to calculate the average of a number of values. Take a look at the formula for the SMA. N is a variable and is the number of time periods in the moving average. And C, for close, is an old friend of ours, the closing price. Although other prices can be averaged, for example, the high, the low, or the midpoint between the high and the low, more often than not it's the closing price that is averaged. So we can see that SMA is simple and that it's an average, but what about the moving? Let's take 5 bars or candlesticks, whichever you prefer, but we'll take 5 bars for the sake of simplicity. With these 5 consecutive bars, we can calculate the first value of our simple moving average. At the beginning of the new day, or hour, or maybe week, a new closing price will be added to our formula, and the last one will drop off at the same time. We've started moving along the price chart. We have selected a variable of 5. It may be 5 days, 5 hours, or 5 weeks, whatever. It's a relatively small period. The moving average dogs the price chart pretty closely. If we increase the period to 10, for example, then the moving average will look smoother and slower. What I mean is that it will react more slowly and smoothly than the price chart. Compare it with a 5-period moving average. If you're using SMA as a trend indicator, then the slower SMA is sounder and more reliable. In previous films, we examined support and resistance in the form of straight lines. What we have here are curvilinear support and resistance made up of moving averages. We can use them as trend indicators. When price is higher than the simple moving average, it's an uptrend, and when price is lower than the moving average, it's a downtrend. This uses the commonly cited major drawback of moving averages, that they lag behind the price chart, to our advantage. But because this average is called simple, it stands to reason there are more complicated averages. Well, first off, my friends, let's remind ourselves that the goal of technical analysis is to forecast future price behavior on the basis of past price behavior. Have you ever heard of a weather forecast based on the statistical data of the amount of snow that fell 10 years ago? It's not likely. Of course, research data should take the past into consideration, but it's the current situation that lies at the heart of any forecast. What I mean is, what happened today is more important, it carries more weight than what happened yesterday, and yesterday's events are more important, they have more weight than those of a year ago. And now let's go back to the formula of the 10-day simple moving average. There's a factor of 1/10 before each closing price, and it's called a weight. In a simple moving average, all the weights are the same, but we want today's price to have the most weight, yesterday's to be a little lighter, the day before yesterday's price to be lighter still, and so on. Let's call this a weighted moving average, or WMA. Naturally, it incorporates the variable of n, and in our case, n equals 10. So what do? To start with, we change the factors in our formula to 10, 9, 8, 7, and so on down to 1. The further the price is from today, the less weight it has. We add the finishing touches to this formula by dividing it by the sum of weighting factors. That's it. Now let's see what the formula generates. It's definitely different. Please note that this new moving average has the same number of time periods, 10, but it's faster and more sensitive to fluctuations in price. Although the formula is simple, it would be a real chore to do the calculations manually. Fortunately, we have Rumus to hand, our technical analysis program, and with its help, we just have to select the time period we want in the parameters window. Let me just remind you once more that the greater the value of n is, the slower the moving average is, regardless of what type it is. So, shall we move on? I'd now like to discuss Bollinger Bands. This is an indicator envelope. We select a moving average and the price range is charted around this MA on the basis of a set of rules. So what are these rules? The first rule is to select a moving average with a time parameter n. To be more precise, if we're working with hourly charts, then n should equal 24. That's 24 hours. And if we're working in a daily time frame, then we'll take n to equal 22. That's a month. These are the natural cycles. The second rule defines the width, or the height, of the range D. By adding and subtracting D from the value of the moving average, we get the upper and lower lines of the Bollinger Band. The value of D is determined by the parameter S, which we select ourselves. The range of permitted values for S lies between 0.5 and 3. But before we go any further, let me explain sigma, the symbol for standard deviation. The sigma value is a sign of the volatility of market prices. Look, for any time period that you select, let's say 24 hourly bars, we can draw a straight line in such a way that the sum of the deviations of the closing prices from this line is the minimum possible. As this line moves along the chart, its incline will change, as will the minimum sum of its deviations. But most importantly, the incline of this line, and it's called linear regression, and the minimum sum of deviations have a precise value that can be accurately calculated using mathematical formulas on a computer. The minimum sum of the deviations of the close price is the basis of the calculation of sigma, the standard deviation. And the standard deviation is the statistical measurement of price volatility for the period n. Sigma is a factor of the width of the range in the Bollinger range. So let's get back to S. D is the width of the range and is equal to S multiplied by sigma. To calculate D, we need to know how many bars our sigma is for and what value of S we've selected. Sigma is calculated for the same period n, which we set for the moving average. If we take S to equal 0.5, then D will look like this. And if we take S as 2.5, then D will equal 2.5 multiplied by sigma, and the Bollinger range will look like this. So, how can we profit from this envelope indicator? Let's work on a daily chart first, with N set at 22 and S at 0.6. If the price breaks the upper line, we get a signal to buy, like this. Can you see the arrow? If the price breaks the lower line, we get a signal to sell. See what it looks like. If the prices are between the upper and lower lines, no trading signals occur. There's some turbulence, and it's a trading range, a sideways movement. We'll continue looking at the overbought and oversold zones in this examination of a slightly more complex oscillator which also incorporates them in its search for reversal. It was developed many years ago by George Lane. Nevertheless, it's been making something of a comeback recently because of modern technology. What's 20 years between friends? The principle of the stochastic oscillator is based on the tendency that, with a general price rise, closing prices as a rule converge to the upper boundary of the price range. And vice versa, when there is a downtrend on the market, they converge to the lower boundary. Several curves are used in this oscillator. The main curve is called percentage K. Stochastic determines the level of the latest closing price relative to a price range for a certain period of time. This is the indicator's first value, N1. The most widespread period used for this curve is 5 days, or hours or weeks. The formula of this curve is strikingly simple. Here it is. It helps determine the position of the last closing price in relation to the lowest price L5 and the highest price H5 of the range for a selected period of time. We've chosen 5 days. The K-curve is very sensitive to price change, and it spends a lot of its time banging its head on the floor or the ceiling. Which is why we don't feature it in rumours. But if we average it, for example over 3 days, we get a slower curve. 3 days is the second oscillator's time period, N2. We'll call the new curve a slow percentage K line, although it'll be the fastest one on our stochastic chart. And here it is. And after averaging or smoothing the new percentage K line for 3 more days, we get a percentage D line, and the third and last time period, N3. We'll chart percentage D as a dotted line on the chart. And that's it. Plotted it at last. So what have we got? 2 lines, a slow percentage K and percentage D. In addition to this, we have 3 time values. N1, 5 is the customary value, and N2 and N3, they're the smoothing periods. We've set them both at 3. And you can play around with them. Your computer will help you again. The K and D curves fluctuate between 0 and 100 on the vertical scale. The overbought and oversold zone should be set with signal lines drawn at 30 and 70. And how does this oscillator generate trading signals? First sight, in the same way as the previous indicator, RSI.